and welcome to BloombergQuint post-budget special, where we're going to discuss the impact on your personal finances or the key budget announcements. Now, the latest figures reveal that the direct tax collections, the CBDT figures in fact said that the direct tax collections are up 12% owing to all the cash that got flushed into the system as a result of demonetization and various disclosure schemes that the government came up with last year. And the expectation was that much of it is and will trickle down to lower rates, more exemptions, overhaul of deductions. But has the budget lived up to that expectation? We have Gaurav Mashruwala, Certified Financial Planner, and Ishita Sengupta from PwC India to answer that for us. First, Gaurav, quick comments on the announcements on, the income tax rate reduction is just from 10 to 5% for those earning up to 5 lakhs. Some more tax saving options. The budget, did it really live up to the expectation that the service class had?
So I think what he is saying is that I'm going to give you consistency, in the sense that not many tweaking. Having said that, which is like overall slab except the lower slab being tweaked, all other slabs have been maintained, but there is an indirect tweaking where somewhere a rebate coming in, somewhere a surcharge coming in. So yes, to bring down from 10 to 5% is a welcome move, but after that, if you're making calculations so complicated, a common man is not going to enjoy. So that's number one. On your comment on saying that has that demonetization collection being trickled down, what they have done is, in fact, Prime Minister already announced a lot of schemes on 31st of December. To that extent, that collection is being used to kind of support low-cost housing, women, rural benefits. So to that extent, they are using it. But if the question is that, is it directly going to a taxpayer? It's not. And I would have really appreciated, while we don't have many people who are paying tax, few individuals who are paying tax, some benefit, if not monetary, some kind of recognition, because he did say that there are very few number of people who are paying tax.
And that sort of set the expectation high when you're saying that, you bringing in words like honest taxpayers, very few, you peak the expectation and then you come up with what, like, a 5 from 10 to 5%? Ishita, are you disappointed?
A bit, I can't deny that, because particularly when he made a reference to the salaried class being the large chunk of honest tax-paying tax filers. At the end of the day, there wasn't really much for the salaried class, and there was a lot of hype, lot of expectation which had built up. So that unfortunately sort of fizzled out. The other thing is, what we see is that there is an attempt to definitely get more people into the tax net, and that is why perhaps this lowering the rate to 5%, because it does impact a lot of first-time filers as well as people who are maybe in the second or third rung in their jobs. Right. So a large cross-section, because one thing you must remember is when we are talking of the taxable income being 5 lakhs, your actual income may be a little more, because that is your net income after you take off all the deductions. So that is a welcome move, but certainly we want more. Wanted
right,
more.
And there were a lot of just not on basic exemption limits, but even in terms of deductions, they could have done a lot, even in terms of simplifying some of these things, but that has not happened. I don't know if any of this is in the fine print, which you guys would have had some time. So Gaurav, let me come to you with some of the fine print that we were talking offline about. Could you take me through the 3 or 4, 5 key changes that we could identify?
So 2-3 things. One is the tax benefit under Rajiv Gandhi Equity Savings Scheme, which has been there. What the memorandum says is that there aren't many takers for it. There aren't many people getting benefit, so slowly it's being phased out.
If I could interrupt you, the benefit here was for the first time equity investors.
In that particular Rajiv Gandhi. Right. So it's saying that people who have claimed benefit will get that benefit, but no more benefit. So that's being phased out. That's number one. Another thing that's come in is NPS. Now, what government is doing is every time they are throwing in more and more sweeteners, they want NPS to be more popular, and they also want people to realize that the retirement money will be what we call as defined contribution, moving from defined benefit, defined contribution. But to make it simple for the viewer, it actually means saying that now you take the market risk, whether you put in government security or corporate bond or equity market, based on whatever your scheme is, the risk is yours, and at the end of it you have to pay some tax. So to that extent, yes, they have brought in one more sweetener, saying that if you withdraw earlier, 25%, there is going to be some tax benefit thrown on. So that's the second thing. Third is mutual fund.
Okay, I want to understand the NPS change first. So what they've done is they have reduced the tax that is going to...
No, they haven't. What happens is that there is some tax benefit at the time of withdrawal.
Right.
Up to certain percent you could withdraw. Now they are saying
without any imposition of tax.
Yes, so portion of it you could withdraw without paying any tax, and balance you go for a annuity, and that gets into it. Now they are saying even if you have to withdraw early, up to 25% they are giving tax benefit.
Okay.
So there's some more sweetness saying your money is not locked in.
Okay.
They want people to get into it. So now otherwise, like youngsters, they were literally saying that, look, I'm putting in money, my money is completely locked in, and if I need money for some specific purpose, I'm not getting it. Or there are some tax implications. So that's additional thing that's being thrown.
So that I don't have to come back to NPS, Gaurav. Tell me now, how does NPS compare with some of the other options that there are? Because NPS gave what, a 50,000 additional sort of investment over and above your ATC's 1.5 limit, right? So now does this change make NPS a sweeter product compared to the peers?
No.
Okay.
And that probably it may not Payaswini, because government doesn't want it that way. So if you compare this with say PPF or EPF, then what happens is in those cases, while I put in money, I get tax benefit. The entire appreciation or growth, whatever word that you want to use, there is tax benefit. When you take out money, there is tax benefit. While in NPS, which is EET, exempt tax, which is a term and which is what government wants, because there is too much of a burden on government when they make even the last part, which is I'm saying E to keep it exempt, is that they're saying there is some tax implications when you withdraw money from NPS, and up to 40% you can take out tax free, and balance you have to purchase annuity. To that extent, it's not comparable to any other products as far as tax treatment is concerned, but I don't think government probably will change. Looks doubtful over coming years, because they want these existing products to move to that. I mean, that's what the thought process, unless there's obviously a political pressure.
So don't make NPS sweeter, make the others more bitter.
They won't make others more bitter, obviously, because they're political compulsions. Can they really make NPS also one like that? I doubt. But at the same time, they are in dilemma. That's why NPS is really not picking up. Leave aside these benefits. Even if somebody wants to go and open an NPS account, PRAN, which is what you need to open account, and it's not easy. Not many banks are kind of forthright in doing it, post office and all. So as a product, it's not picking up more from individual perspective. So there's some other benefit also that they would announce, or there's something. But NPS is not picking up the way government wanted it. At the same time, they don't want to take it to a situation where there are assured returns and entire money is tax exempt at time withdrawal. So this is there, maybe over a period of time, over a few years or decades, we would see NPS as a main product and others being phased out. But
yeah, when we have pension in the name of the scheme, you associate it with as without risk, but it is a risk product at the end of the day compared to the peers.
that's the way it is worldwide.
Right. All right. Okay. The third change that you want to talk about is some of the consolidation benefits in mutual funds.
In mutual fund, what has been happening is couple of years ago, mutual funds were launching too many schemes, and then SEBI came down saying that schemes with similar investment philosophy or whatever word that you want to use, you should start merging. Now, when that merger would happen, there would be some implications, or when you sell those merged things. Now what they are saying is that when did you purchase was the biggest problem, because should we take into consideration the day schemes got merged, or for you the day you had originally purchased. Now schemes merging is not in the control of the investor. Correction is just a clarification that has come in, is that now it will be the original purchase price, and the tax benefit that will be given to you based on long term will be based on that. And just because this is not in your control, you will not be subject to unnecessary taxes.
So far investors were sort of
exactly
taking the brunt of it?
So, for example, if I invested say 10 years ago, or 3 years ago, or 7 years ago, and two schemes merged, so what was happening was that my tax effective was saying that from the day it merged, my scheme was merging it to other scheme. And hence, there was a tax implication saying that you sold only after a year if I have sold after a merger. But it's not my fault. So they are saying we'll give you that benefit of any purchase.
All right, Ishita, let me come to you with some of the fine print that you may have observed in the budget and its implications really for the taxpayers.
Sure. So, one significant one is in terms of loss from house property, from rented, so from let out property. So, if I am a homeowner and I have let out that property, so I show my rental income, and if I have a loan on that house, then I am able to take the full benefit of the interest that I pay during the year. And if I had a resultant loss arising from that, I could set it off against my other income, which was typically the case with a lot of people who were second home, third home buyers. Now what's going to happen is they have restricted that loss, because for self-occupied property you had the interest deduction available till 2 lakhs. So they have brought in parity. There was an expectation that they will increase the benefit for self-occupied. It's gone the other way. So what he's done is he's brought down the deduction available for let out property. So it's going to be restricted. The loss that you can set off against other income is going to be restricted to 2 lakhs in a year, so and the balance you can carry forward.
Okay, so when you say the loss, it means that probably the loan EMI that I'm paying for that loan.
No, so if you have rental income,
right,
and then you are able to take a deduction with respect to the entire interest,
right,
you have a resultant loss,
right,
that loss.
Okay.
So that loss earlier was regardless of the amount, you could knock it off against your other income, so long as you had other income.
right.
But now it gets carried forward,
Okay.
and the interesting thing is that it gets carried forward as loss from house property. So there will be restrictions in terms of how you, because once you have carried forward house property loss, you can set it off only against income from house property. So that is something which was a bit of a surprise in the fine print,
Okay.
and it actually impacts people who are investing into second or third homes for the purpose of getting some rental income. Of course, the surcharge on the 50 to that's not in the fine print though, that was there in the speech as well. So that's also a hit for the people in that bracket.
People who are above the 50, above the 50 lakh limit,
50 to 1 crore.
50 to 1 crore, the surcharge will be 12%.
10%.
10%?
Yeah. So effectively, what happens is the earlier rate that you had applicable for people above 1 crore now gets.
So that becomes 10, and over 1 crore I think has now become 15%.
15. It was 15. It is now. It continues. So in that sense, the hardest hit category is that 50 lakh to 1 crore.
Okay.
Because beyond 1 crore it remains the same. There's no change really. The lowest gets a benefit of the reduction in the tax rate.
Right.
So it's that category which sort of gets impacted.
Okay. Anything else that
the other is not so much in the fine print really, but so one more thing is that there will be a fee or a fine, whatever you may call it, for filing a delayed tax return.
Okay.
So for income above 5 lakhs, if you file it by 31st December, then there's a 5,000 fine, and if you file it by 31st March, then it is 10,000. For people who have income below 5 lakhs, it is 1,000.
Okay.
So this was not there earlier. So if I missed my deadline on 31st July, I could have filed by the next 31st March. But now it has got a monetary implication.
Okay, all right. He also spoke about increasing some tax saving options, though the finance minister didn't elaborate much on the instruments. But what could he be alluding to?
So what he was talking about is currently says section 54 EC, which means if there is capital gains, long-term capital gains, I have option of either paying tax or I have option of investing in bonds, capital gains tax bonds, popularly known as, and the benefit is under section 54 EC. What he has said is that more instruments will be brought in so that SSC or an individual who has to invest has more options, and that's the only thing which has been said even in the fine print, saying that more instruments will be brought in, but those instruments have not yet been named. So I guess over a period of time, based on the requirement of where government wants to give in thrust, will bring in more instruments. So there isn't anything major coming in. I mean, this could have happened over a period of time with a way of life. I mean, there wasn't any major thing that needed to be done. 2-3 other things that should be looked into is, number one, for senior citizens. Prime Minister spoke about that 8% product on 31st.
LIC to come up with.
That's right. So the LIC is going to come up with their product, and which is appreciated. The only concern is that now we have too many products. There's senior citizen savings scheme, there is post office monthly income scheme, which is obviously not only for senior citizens. Then we have third. Now instead of bringing in more and more schemes, probably there is a need to get in situation where you enhance the limit of the existing scheme, because senior citizens get too confused because there are different tenures and there are different tax implications. So that's number one. So there are two other benefits which is coming for a common man as well. One of them is the more ETF of that PSU ETF that we have. So they are talking about more ETFs coming in where an individual can invest. So directly indirect participation by a common man into exchange traded funds which are investing actually in the stocks of PSUs.
Yes.
So that was
so more divestments, which means more
exactly. So that is one, and the stocks of IRCTC and other railway. So it could be leading to privatization of railway. I feel that happens, but slowly moving towards that. But at least two companies related to railways, those will be listed, and the moment it gets listed, I'm sure a common man can participate.
Sure. Ishita, there is also change in base year from 1981 to 2001 which probably will lead to reduction in the capital gains tax liability of the assessees. That's an important one, right?
Yeah, in fact, a related change also is that he's reduced the holding period for classifying immovable property as long term. By reducing it from 3 years to 2 years. So typically if I own a property and I am waiting to invest in another property and I want to sell this, I had to wait for 3 years before I could do it if I was to take a long-term capital gain benefit. Yeah. Now that has reduced to, so there's I think an indirect fillip to the housing industry, I think.
Right.
And regarding this, so whenever I have a long-term asset, I can apply an indexation because of the change in your inflation. There's a cost inflation index for each year which is notified by the government. So the base year was 1st of April 1981. So if you had a property which was you purchased before that, you could apply that rate as a choice and the fair market value on that. So now they have brought it forward. So there will be a cost correction in that sense.
Okay, all right. So not directly maybe benefiting the service class, but in some sense the sellers of properties essentially, and even some benefit in affordable housing, right, from built up area to carpet area.
Yes,
that is also probably
so it's so not so much really in terms of the individual, but then you get that benefit for the housing sector.
Payaswini, basically there is a thrust on housing.
Yes.
And if I recall correctly, I'm not very sure, is that when the government came in, they said we are going to have about 10 crore more houses coming in, and hence every union budget would have something or the other in terms of housing coming in. So all these benefits, also giving low cost housing status of infrastructure, a big welcome move. All those are the moves in the direction of encouraging housing. Two things happen. One is people get into a situation where they are purchasing house to live, number one. Number two, if housing industry and housing sector grows, it's supporting lot many other ancillary industries. So it's a big impetus to overall growth. To that extent, support and encouragement and enhancement in housing is what we will continue to see even for next 2 financial years till the government is there.
In fact, Payaswini, we were speaking about job creation, right? And this is one of the sectors typically which would generate employment, and that's one of the objectives, I think. So a lot of, this time if you see, there are a lot of changes from all the aspects of the housing industry.
Right. Before I ask for quick wrap-up comments, because there might be some more points in the fine print that we'll discover on the course of next couple of days. We also did speak about some of the TDS related changes, or rather making the TDS process a little less tedious, which was also a recommendation of the Ishwar committee. Could you find any of that in the fine print?
There was some reference to a 5% TDS on rent payments. The only thing which I quickly read, and I need to go back and read it in more detail, was that you don't have to register for a TAN number, and you can just pay the TDS. So I think it would be similar to when you are selling property, and the buyer deducts TDS before on the capital gain at 1%. So I think some similar sort of process they have brought in, but I don't see any
major
no,
changes in
no.
the process per se.
Not yet.
All right, okay. Gaurav, Ishita, thank you for bringing out some of the fine print that many of us haven't sort of read so far. And over the next couple of days, we will have much more to talk about in terms of how the budget 2017 can impact your personal finances. Gaurav, Ishita, thank you very much for your time and thank you for watching.